Good morning and welcome to the Click & Co Market Update. Clearly one of the biggest bits of financial news over the last few months has been the tariffs that Donald Trump is trying to impose on both China and Europe. So that's been causing a bit of concern for investors recently, and it has been causing a few wobbles in the market. So we've first of all been looking at the tariffs being imposed on China, and so far it does appear that these are not having the effect that Trump wanted. So he imposed these tariffs in order to make Chinese goods seem more expensive to US buyers, in the hope that US buyers would then buy from US manufacturers instead, and that was hoped to be good for the US economy. However, since the tariffs were imposed, the Chinese currency has fallen by quite a significant amount, and that's actually wiped out a lot of the effects of the tariffs. So have a look at this chart here, which shows the US dollar versus the Chinese renminbi. And as you can see, since April 2018, the currency has fallen by about 9%. So that's gone quite a long way towards wiping out the effect of some of these tariffs. So you can imagine that Trump is probably quite annoyed about that. And it's also quite clear that the relations between China and the US are not particularly strong at the moment, and that was highlighted this week by a technology deal that the US has been trying to get through for 2 years now. So US chipmaker Qualcomm has been trying to buy a Dutch chipmaker called NXP for $44 billion. They've been trying to get this deal through for 2 years. It needs the approval of quite a few different regulators around the world because both companies are so international. And this week the deal fell through because the Chinese regulator would not give approval. So perhaps that's a way of China retaliating against these tariffs that the US has imposed. However, the situation between the US and Europe is looking a bit more positive now. We've been told this week that a number of European officials have travelled to the US to speak with Trump about the tariffs, and we've been told that both sides are very keen to work towards a zero tariff environment. So that's definitely good news, and that's why European markets are up on Thursday morning this week. And we spoke 2 weeks ago about NATO and the fact that most member countries of NATO are not spending the agreed 2% of gross domestic product on defence. And Trump is actually quite keen to push this figure even higher to 4%. So over the last week, we've been looking a bit more at global military expenditure and also defence stocks. So this chart here shows you world military expenditure over the last few years. As you can see, since 2010, the figure has remained fairly constant, but in 2017 there was a small rise and the figure went up to $1.7 trillion. So that's a huge number. It equates to $230 for every single person in the world. But perhaps more significantly, it equates to 2.2% of global GDP. Now, we've already said that most member countries of NATO are not spending the agreed 2%. So what's happening to push the average up to 2.2%? The answer is China and also Saudi Arabia. So both of those countries have really significantly increased their spending on the military over the last few years. So have a look at this chart here, which shows you how much each country is spending on defence. So the size of the bubble indicates the amount that country is spending. As you can see, the US is by far the world leader, but China and Saudi Arabia are becoming increasingly significant. So definitely something to keep an eye on there. And looking at performance of defence stocks on the market, this chart here shows the NYSE Arca Defence Index. So just an accumulation of various defence stocks on the US exchange. As you can see, it's done very well over the last year. It's actually up by 80%. But what's quite interesting is that the average stock in this index is trading on 14 times as a price to earnings ratio. And that's quite notably below the average on the US exchange as a whole. So please do call us if you would like to speak about defence stocks in more detail. And finally this week we've been looking at a recent report from Ofcom which shows that we now have more people in the UK subscribing to streaming services such as Netflix and Amazon than we do have people subscribing to pay TV services such as Sky, Virgin and BT. And I think this is quite an important turning point for the UK, and also it does highlight the value of having good content. So we know that Netflix and Amazon between them spent £7.6 billion on content last year, whereas in the UK, the BBC, ITV, Channel 4 and Channel 5 combined only spent £2.5 billion. So perhaps that's one reason why the subscribing numbers there are falling. Now, looking at the stock market, we have seen a number of battles between companies because they want to own the most valuable content. And one of the major stories in the news has been the battle to own 21st Century Fox. And we have seen bids from both Comcast and Disney. However, Comcast has now dropped out of the race, leaving it clear for Disney. And it is expected that shareholders from both Disney and 21st Century Fox will vote the deal through this Friday. So please do give us a call if you would like to speak about Disney in more detail. Now, moving on to the week ahead, still lots of companies reporting because it is still the second quarter reporting season. But to give you a few, we've got Apple, we've got Xylem, we've got Lloyds Banking Group, and we've got Direct Line. That's it from us. Have a great weekend, and we'll see you next week.